When we're setting up a company, we have three main options. There are several other options out there, but these are the three main ones we're focusing on at this point. We have a sole proprietorship, which is basically where you have one owner. There's not a whole lot of red tape to set this up, and the only investor would be this owner. They may borrow money, but they're the only investor. Partnership means that you have more than one person. It's the same thing as a sole proprietorship, except that you have more than one person. So you can think of it as a two-person proprietorship, a three-person proprietorship. It's a partnership. There's really no limit to how many owners you have in a partnership. Theoretically, you could have 100, you could have, I guess you could have 1,000 if you wanted to be that crazy. But generally, when you get to huge numbers of owners like that, a partnership doesn't make sense anymore. It gets too convoluted. A corporation, on the other hand, is where you could have one owner, or you could have hundreds, thousands, tens of thousands. There's really no limit to that either. A corporation is where you now have a separate legal entity. The corporation is an entity all in its own, separate from the owners. So what that basically means is that you have investors that have invested their money in the corporation, but they have no legal liability for any lawsuit against the company itself. They have no legal liability. The only thing they could lose is their investment. If you have a rich stockholder that only invested a little bit in that company, someone sues the company, but the company doesn't have enough assets to cover that lawsuit, those people can't also come after that individual, that rich investor. The only thing that rich investor can lose is whatever he invested in this company. The stock is now worthless. He can't lose any of his own personal wealth unless he did something wrong individually. Sarbanes-Oxley Act. This is an act that was enacted in 2002. You may recall in the news around that time there were several companies, several scandals going on. Enron, WorldCom, Tyco, those are just a few of the many examples. Because of what happened here, all these scandals, Congress realized that they needed to increase the regulation. So they passed this act in 2002 that helped to try to curb these financial abuses. So the whole goal here was to get investors to trust the information they were given, because obviously they were losing trust due to all these scandals. So hopefully this increased regulation would help these companies to be more honest, hire executives that are going to be more honest, and punish them if they're not. So all of this should give investors, or allow them to trust the information more. So now we're going to get on to some of the rules in accounting and how we apply them. Earlier I said that there are some rules that have exceptions and some that don't. This rule right here is one that has absolutely no exception to it. Assets equals liabilities plus equity. This is our basic accounting equation. We can look at this a couple of different ways. Assets are all the things that the company owns. How did they buy them? Maybe they borrowed money, which means they have a liability to the bank or whoever. Or maybe they bought those assets because an owner invested money into the company through equity. Equity represents the owner's portion of the investment. So the liabilities are the creditors lending money to the company, and the equity is the investors investing money and becoming part owner of the company. So they have all these assets. They had to have financed those purchases one way or the other. That's kind of what we're looking at through the first option. The second option is that the company has all these assets. Somebody has a claim to those assets. The first claim comes from the creditors. So in other words, if these creditors lent money to the company and this company either fails to pay it back or they go out of business, they'll get their money back first by forcing a sale of some of these assets. Whatever's left is the owner's claim. Equity is known as the owner's claim to those assets. And it's whatever's left, basically. It's the residual claim. The assets are sold, the creditors are paid off, and if there's anything left, that's the owner's money. Hopefully it's more than they invested. So here we have a few things we're going to look at. We're going to look at assets. We're going to break them down and see what types of assets do we have. These are just examples. You could keep going on and on with this list. We have a cash. That's an asset. It's a resource the company owns. They could have it in physical cash or they could have it in a bank account, whatever the deal is. We have two different types of receivables, accounts receivables and notes receivables. Accounts receivables are fairly informal. It's where we've shipped a product off to the customer and they owe us money in 30 days or so. So we expect to receive it in the near future. A notes receivable is a little bit more formal. Someone has signed a promissory note promising to pay us a certain amount of money, most likely with interest, and generally it's a little bit longer term than an accounts receivable. It's a little more formal, longer, and it has interest. We could have vehicles, we could have store supplies, equipment, building, land, any resource the company owns and controls that we can use in our operations. That's an asset. A liability is basically something we owe. We owe to someone else for some reason. It's the creditor's claims on the assets. The creditors have lent us money, or for some reason we owe them money, and if we don't pay them off, they have a claim against our assets. They'd have to go to the court to sue us to get those, but they do have a very valid legal claim. Accounts payable and notes payable, very similar to accounts and notes receivable. The only difference is we're on the other side now. We owe the money. Taxes payable, we owe the government, whoever. Wages payable, we owe our employees. These are just four brief examples of liabilities. And equity, this is the owner's claims on the assets. Now this could happen a few different ways. Contributed capital, that's the money they actually invested into the company. They bought stock through the initial public offering. That shows their investment. Now over time, if this company earns more and more money, this increases what's called retained earnings. In other words, this is all the net income of a company over its life that they've chosen to retain. So in other words, they haven't paid this out to the owners in the form of a dividend yet. They've retained it. Now the other part of that is dividends, which basically come from retained earnings. It's when the company decides to pay out some of those retained earnings to the owners. They don't have a use for that money. They don't need to invest it in their own company. They don't need to grow. So they're going to pay some of that out to the dividends, or to the owners through dividends. So let's expand that out a bit. We know we have all those types of assets. We have all those types of liabilities. But equity, we need to look at how it's actually calculated. Contributed capital is on one side, and then retained earnings is on the other side. Now, retained earnings has three pieces to it. Revenues minus expenses, that gives us net income. Net income feeds into retained earnings. And then you see the subtraction for dividends. Dividends reduce retained earnings. So here we have transaction analysis. This is kind of the starting point for accounting. We're taking a look at what has happened in the company and how do we record it. We have two main types, external and internal transactions. External transactions are when maybe the company has gone outside of the company to purchase something from a store. They've paid cash, they've set up an accounts payable, whatever, to external parties. A transaction, you'll have a receipt, you'll have all of this. Internal transactions are changes that happen within the entity. Let's say, first of all, we went into a store, we bought supplies. That's an external transaction. Now we have all those supplies in our supply room. Different departments are going to that supply room to pull those supplies and use them. That part is an internal transaction. Things are changing hands, but it's internally, and we're going to record them at the end of the period. So let's take a look at a few examples of transaction analysis. Here we have J. Scott investing $20,000 cash to start a business in return for stock. So the asset, cash, is increasing for the company, and equity, in this case common stock, contributed capital, that's increasing as well. The owner has invested money through equity. So notice that our balance sheet equation, or accounting equation, is still in balance. Now we purchase supplies by paying $1,000 cash. Our cash asset went down by $1,000, but our supplies asset went up by $1,000. We're still in balance. That's zeroed out. Our equipment, the cash went down because we bought equipment. The other asset, equipment itself, went up. So again, that zeroes itself out. We're in balance. Now we purchase supplies of $200 and equipment of $1,000 on account. So we have two different assets that are increasing by a total of $1,200. And on the other side, liabilities, in this case accounts payable, are increasing as well. So both sides increased by $1,200. Here we borrowed $4,000 from the bank, so our cash went up, our notes payable went up. Both sides went up by $4,000. We're still in balance. So if you take a look at it in total, our assets are $25,200, and our total liabilities and equity are $25,200 as well. We're going to continue on and look at some more transactions. This time we're going to look at the equity side, including revenues, expenses, and dividends. So with this example, we've provided consulting services receiving $3,000 cash. So we debit cash to increase that asset. We credit revenue, or I'm sorry, we shouldn't say debit. We increased cash, which is an asset, by $3,000, and we increased revenues by $3,000 as well. So both sides are in balance. Now we're going to see a trick one. We paid salaries of $800 to employees. Our cash asset went down, but our expense on the other side went up. We're increasing the expense. At first glance, that looks like we're not in balance. One side went down, the other side went up. But remember that expenses, even though the expense itself is going up, that expense reduces net income, which reduces retained earnings, which reduces overall equity. So even though expense goes up, equity itself is going down, just like the asset is going down. So we're still in balance. The same can hold true with dividends. We're paying a $500 cash dividend to shareholders. Cash is going down, and dividends themselves are going up. But remember, dividends reduce retained earnings, which reduces equity. So dividends goes up, but overall equity goes down, just like the overall assets went down. So now we've taken a look at some transactions. Here's the first time we're going to look at the financial statements themselves. This is the information that the investors get about the company. This is a prescribed format that's required for them to follow. And the order we have here is actually the order these will be presented in. We start with the income statement. We go to the statement of retained earnings. Then we go to the balance sheet. Then the statement of cash flows. So here is a very quick example of what an income statement might look like. It's basically revenue minus expenses. In this case, they only had one revenue, one expense. In reality, companies are going to have several revenues, several expenses. But in any case, if your revenues were higher than your expenses, you get a net income. If for some reason you had a bad year and you had less revenues than expenses, it would be a negative net income, which is known as a net loss. Note that the income statement is a period of time. In this case, it's a month. It shows you what happened throughout that entire period. That net income figure is used to carry over to the statement of retained earnings. The statement of retained earnings is also a period. It shows us for the same month. So we started the period with a zero balance of retained earnings. We added in net income, which in this case was $2,200. From the income statement, we subtract out dividends of $500, we get ending retained earnings. That ending retained earnings balance is going to come over to the balance sheet. That's a component of equity, as we talked about before, but this is where the balance comes from. The balance statement or the balance sheet is a snapshot. It's not a period of time. It's a snapshot of balances at a certain date. So it shows all of our assets, and then it shows all of our liabilities and all of our equity. This ties into that accounting equation, sometimes known as the balance sheet equation. We make sure that we are actually in balance. That's all we're doing here. The last statement of the four is the statement of cash flows. This tells us how we received cash, how we used it. It breaks down our main reasons for receiving or using that cash. We have three main categories that we're going to talk about here: operating activities, investing activities, and financing activities. The operating activities are your day-to-day operations, what you normally have to go through. You receive cash from clients, you pay bills off, just day-to-day stuff. Investing is when the company invests in themselves by growing, by buying new equipment, new buildings, whatever. And then financing is basically how did they finance all those operations, all those investments. Did they borrow money? Did they get an investment from shareholders? What did they do, whether it's an inflow or an outflow? We get subtotals at each of those three categories, and then we get a net increase or decrease in cash. We add that to the cash balance at the beginning of the year, or the beginning of the period, and that tells us what we expect to have at the end of the period. And guess what? We can take this $9,700, and that better tie back to what we show on the balance sheet. So that's how the balance sheet ties to the cash flow statement. The last thing we'll talk about in this chapter are a couple of ratios that are important. We have the return on assets ratio, sometimes known as return on income. This basically tells us what return we got by using all the assets we had throughout the period. So it's net income divided by average total assets, which is also known as your investment in the company. You invest in your own company, or a company invests in itself by buying more assets, buying more long-term equipment, all of that. So you had all these assets. What return were you able to generate? Your return is net income. By the way, anytime you see average, that is basically the beginning of the year amount plus the ending year amount divided by 2. It's a simple average. That takes us to the end of this chapter. Now, if you have any questions on any of these materials as we're introducing these topics, please feel free to let me know, and I'll be glad to help you out. I thank you for your time, and I will talk to you in the next chapter review session.